Thank you, David. That was excellent. I think there's probably going to be a lot of questions and follow-up from the audience, and we will, as I mentioned, have mic runners, and there's also, of course, an email that you can send your questions to, info@cfawinnipeg.ca. David, a lot to pick up on there. I want to first start with your comments on Paul Volcker, because I do think it was pretty shocking, or should have been, or at least enlightening for people to see or hear from Powell his views on Paul Volcker. Do you think, though, because we've observed him now for a number of years, Powell, that this is part of his game plan, trying to make sure the markets know that he's serious about raising rates, to kind of prepare them, but he's not going to be a Paul Volcker?
Well, I think that there's a good part of what you said is true, which is that the Fed seems to be very embarrassed right now, and that they missed this inflation call, although it's completely understandable as to why they did. The Bank of Japan isn't changing policy, and the ECB isn't changing policy. The PBOC is actually easing policy. They don't have an inflation problem, that much is true. I think it definitely is an attempt, Catherine, to build credibility. Okay. But to say at this point, now you see people say, well, they won't have to do as much because they've created the conditions for the market to price all this in. So the market's done the work for them, is a bit disingenuous. The only way that they don't live up to what's priced in is if something really nasty happens. It has to be, I think, not just equities, but a real credit event has to happen. And that's really what the story was when people talk about what happened in late 2018. We didn't have a high yield bond being issued for about a 6-week period. I mean, spreads blew out. It wasn't just the equity market. The credit markets became dysfunctional. We'd have to have a credit event, or we have to start seeing my forecast really come true in one particular part of the economy, which is the labor market. So we have to start to see the payroll numbers really slow down dramatically, the participation rate go up. Like when people start to see that the economy is not that strong, these people that thought that they could retire early, which has been frustrating to watch the participation rate not go up for older people because they think they got their bucket list and they got the 401k plan, I'm going to retire early. They're starting to come back already. We start to see the unemployment rate hook up, and I'll just say this much, the statistic, if the unemployment rate goes up 0.4% or more, you're in a recession. That's tried, tested, and true. You say to me, oh, what, does that mean 4% of recession? That's exactly what I mean. It's the change, not the level. So those are the things I think that we got to pay attention to. But no, until they happen, they're on autopilot. I mean, you had Bullard today. Bullard's become whatever. He's become like the, Leonardo DiCaprio. There's not a camera he doesn't like to be in front of. It's 75. Now they're talking 75 basis points. Why not go 100? But now their credibility will suffer the other way. I think they've gone too far in having the markets price it in, and then they'll have to live up to it. And the only way they don't is if some accident happens along the way or the labor market starts to deteriorate.
David, some of the bulls, though, would say that that we have actually seen perhaps peak inflation in the March time period. Many of those economist strategists would be citing the used auto market that contributed to such a degree to the inflation picture. Some of the bulls would also say that we actually would do well to see the unemployment rate rise a bit. Well, that the labor market's obviously too tight.
Well, that's what I mean. That's what I was talking about before. The unemployment rate just came down too far, too fast. And that's why we're late cycle. And it sounds so weird to say, well, the unemployment rate being low is a bad thing. I'm not saying it's bad or it's good. It's just classic late cycle, end of cycle. That's really what it is. I don't have a problem with the view that inflation is peaking. I don't have a problem with that at all. I mean, let's hope it is at 8.5%. And it probably is. It probably is. If I put myself in the Fed shoes, I think here's what they're worried about. it's not about, so if it goes from 8.5 to 7.5, are we going to be like dancing around doing high fives? I mean, wow, they're concerned that the longer it stays unusually high, that inflation expectations are to become unhinged. They are concerned about a wage price spiral. It hasn't happened yet. You did have a wage price spiral in the 1970s. Of course, you had a much more, the unions back then transcended, Starbucks and Amazon. They don't want to see a wage price spiral. So everything they're doing right now is an insurance policy. Inflation is peaking, but they don't know how far it's going to fall. All right. Don't forget they have a 2% target. It's not going to. There's no get out of jail free card just because inflation is peaking right now. It would have to go down a lot. By the way, I think that by next year it will be down a lot. It will be down a lot. And I'm not justifying what the Fed is doing. A lot of people think what they're doing is correct, that they're actually making up for lost time. They're behind the curve. They're not really behind the curve. If they're behind the curve, we'd have a much bigger bear steepener in the Treasury curve. The US dollar would be tanking. There's no sign that the Fed has really lost credibility. Although they've come under a lot of attack in political circles and in academia, on television, and they're taking it to heart. I think actually that when we read the transcripts from the current meetings 5 years from now, I can't wait to do that, that we're going to find that they're probably willing to accept, quotes, a mild recession. So when you're talking about Volcker, of course, those recessions weren't mild, but I think that's the trade-off right now they're willing to accept.
And they're willing to accept that because they need to control the inflation.
Well, we'll see what happens this time next year. I think this time next year, this is why I'm bullish on treasuries. I think that inflation is going to come down. It's hard to say will it come down to 2%. I don't think it really has to come down that quickly. It'll peak out. I think that the one thing, we got this number today that was really, should have been a great number for the bond market, and it was the housing start number in the United States. Now, it wasn't about single-family starts. There's a boom in the United States right now. Multi-unit construction is booming. And in fact, units under construction in the rental sector is the highest it's been since 1974. So we're seeing the supply response. The one thing a lot of people don't know, of course economists know this, is that 30% of the CPI is related to rents. And of course, they've been accelerating. Now, we got to luck out. I mean, at some point, oil will hopefully stabilize. We'll see. At some point, food will stabilize. If we get the demand destruction that I'm talking about in durable goods, there's going to be an impact. I mean, companies will not have an easy time raising prices. Their margins will be compressed in the coming year. They probably did a great job. I mean, look, we lumped in, when you think about it, I didn't have this chart, but I do have this chart that I've run with that shows the change in the inflation rate, which is a second derivative. It's the highest it's been since 1951, and before that 1947, when the troops were coming home. And the corporate sector, and this might be somewhere where, Biden might not be wrong when he talks about price gouging, okay? That the corporate sector has lumped in 4 years of price increases into one. And wages haven't gone up that much, okay? And of course you've had, say, how food prices influences somebody who's a manufacturer. I mean, give me a break. Energy does, sure, raw materials do. But you can do that at the peak of the cycle. You cannot raise prices in a recession. That's one thing I want to make a point here, is that the reason why bond yields go down in a recession is that inflation goes down in a recession because you get the demand destruction, which probably the Fed wants to see. But I'll say that the big surprise, and especially because shelter is such a big weighting in the CPI, the big surprise is going to be that we're going to be faced with a deluge of rental supply. All this talk today, low vacancy rates, rental inflation, and plus don't forget, interest rates are going to have a big impact on home prices, okay? Now these things all happen with a lag, okay? And remember, it wasn't until really 2006, 2007 that the home prices started to really erode. There's lags involved, but that's going to have a very big disinflationary impact. People can't see past the tip of their nose. We had, we've just come off these multiple shocks, and they've been inflationary shocks, and people have just lost their mind because they can't see the forest past the trees. We had, this is the first shock of this magnitude in a century. Okay, we had back then we had World War I, and then we had the Spanish flu. We had a shooting war in Europe, and we had a health crisis. That was global. And now we had it in reverse. We had a global pandemic, and then we have a war. And wars are inflationary. And pandemics or health crises have pernicious supply side. This is a massive supply side shock. So I don't know. I'll tell you right now. I'm not embarrassed to say this. Transitory could be a couple of years. I guess we've become so trained because, to an investor today, I guess, long term is lunch next Friday. We had actually 4 years, from 1916 to 1920, inflation averaged 15% per year. 15% per year. And then when the shock subsided in 1920, and they subsided, we actually had 10 years of deflation. We had 10 years of deflation right up until 1929. And then, of course, we had the crash. And so, very dangerous to extrapolate what's happening today into the future. And I say that especially it pertains to inflation, and particularly to Bob Farrell and the rule on there are no new eras. I do not buy into the new inflation era, not a bit. It's funny, when was F. Scott Fitzgerald wrote The Great Gatsby and when? Like 1926? There's not one mention about the fact that 5 years earlier there was 15% inflation.
Mm-hmm. So, David, you mentioned that the Fed is now panicking and that the Fed and the BOC will cause an unnecessary recession. What do you mean by that?
Well, it's exactly what I said before, is that we have to have an assumption that these shocks will subside. And look, we got hit with another huge shock just in the past, say, couple of months with China, and their recurring, very aggressive zero COVID policy. And that's had an added impact on cost pressures because of the importance on global supply chains. Got to assume at some point, these supply pressures will subside. I'd say that I don't have a problem. I think the Fed should have started the process, and the Bank of Canada, to its credit, did start the process earlier of ending the ridiculous policy of quantitative easing. I think the Fed, and there's going to be a price to pay for buying mortgage-backed securities on their balance sheet last year into a bigger housing bubble, or at least as big as it was back in the mid-2000s. There will be a price to pay for that. So they made a mistake there. I don't have a problem with the fact that nudge rates up, get them off zero. But look, they're telling you, the bank just went 50 basis points. The Fed's telling you they're going to go 50 at the next two meetings. Bullard's talking 75. This is a major interest rate shock we're talking about. Into economies, Canada and the US, we have never been this leveraged before. Mm-hmm. And so, I think that you got to then wonder, we're going to have another recession. I think inflation is going to come down on its own accord, in my opinion. Doesn't mean that they shouldn't be raising interest rates and shouldn't be undertaking some moderate form of quantitative tightening. I agree with all that. The Fed, though, when you look at the Fed, what I'm saying is that when you look at what they're going to do, it's going to be about 400 basis points worth of tightening, just this year alone. Mm-hmm. And so I think that there's a risk it's going to create a recession. Then we got to ask ourselves, how do we get out of it? Where's the fiscal bullets to get out of the next recession? I'm talking mostly about the U.S. At least in Canada, when you have a Liberal and NDP coalition fiscal policy, yeah, bring it on. It's a little. we don't have Joe Manchin, although I wish we did. But fiscal policy is going to be tricky, and so it's difficult to know how. What's the Fed gonna What's the Fed gonna do? What's in the next recession? You can see after each and every recession how much more they have to do. Right. And so I think that these are the things we should be talking about.
So David, then what does the next recession really look like to you, and the process of getting there, in the sense that it doesn't sound as though you think we're going to see the 15% inflation rate, that we will in fact see inflation come down, but between now and then, how should people be thinking about how the interest rate environment is affecting them? We're going to have higher rates, maybe lower, slower growth. Do you see all of the above, inflation, stagflation, and deflation?
Well, I mean, I think that you could call it stagflation light. I mean, it's tough. Stagflation, they talked about that in the 1970s because you had double-digit unemployment and double-digit inflation. You know, we have 5% unemployment. You know, in Canada, it's, you know, sub 4 in the United States. So it's to talk about stagflation. It doesn't mean that we won't get into a stagflation when we go into the recession phase. But I think inflation is going to come down. Like, of course, you have to build up certain assumptions. The Fed is going to make sure, and the Bank Canada, but let's face it, the Fed is more important. They're going to make sure, they're just telling you, we are not accommodating, we're not going to accommodate these price shocks. But these price shocks are mostly food and energy. These are de facto tax increases on the poor, the middle class, and the elderly. So what they're telling you is that the Fed is telling us all that this is going to be, going forward, a relative price shock, okay? That we're not going to accommodate it, which means that now that if food and autos and semiconductors and things are going to semiconductors, if all this stuff related to global supply chains and the war in China, too bad, we are not going to accommodate it, which means that everything else, call it the other 70% in the price system, is going to have to deflate. Okay, that's what they're telling you. We're not going to accommodate this. So something's going to have to give. The thing about food and energy, as I said before, they're incredibly demand inelastic. You can't get away from them in the near term. So I got news for you. If you think you've got pricing power in your particular business, and you're not in the agri-food business, and you're not in the LNG business, your business is going to be pretty tough because the Fed is going to engage, as I said before, in a policy now of shifting the demand curve to the left, which is negative growth in consumption. And so that's where we come out with the fact that, no, see, the thing is that nobody ever thought inflation was going to come down in the early 80s. Volcker did exactly that. Now, I'm not going to say interest rates aren't going to 20%, okay? There's just so much leverage in the system, there's no possible way they're going to get up that high. But if you adjust for how much leverage there is in the system now compared to Volcker, I got news for you. Going to like 3% is going to feel like it because there's so much leverage in the system. And of course, we become much more of an asset-dependent economy, residential real estate and equities. And that's actually what has me concerned the most, is that we're going to have deflation in assets. The question is, how does that play out in terms of consumer inflation down the road? So I actually think that people will be very surprised. I'll just say this much. Remember what happened? I was getting into arguments with my friend Rich Bernstein, who was a strategist at Merrill. I was the economist. We had inflation debates like crazy back in when? Summer of '08. And back then it wasn't about supply chains. It was about China's voracious appetite for commodities. It was a commodity super cycle and global decoupling. Remember global decoupling? You guys remember that Aesop fable? And oil got to $145 a barrel in the summer of '08. The Fed switched to a tightening bias, summer of '08. This is 2 months before Merrill and Lehman and AIG. And Trichet actually raised rates because of oil. Inflation in the United States was touching 6% at that time. Okay, not 8.5. And the very next year, if you told anybody in the summer of '08, when inflation was almost 6, that in 12 months' time it was going to be -2, you'd have been carried out in a gurney. Now, as it turned out, we had a recession anyways, because the Fed had already raised interest rates pretty aggressively. But it would have been even worse if they kept on raising rates and had that oil price shock.
So if the view is that we will have a recession and, you know, we don't know what it's going to look like, but perhaps the real question to ask is what policies can be put in place to get us out, and how long does that recession last?
Well, look, it could well be, we don't know for sure. Like, we don't know what's really said at those FOMC meetings. I am respectful to a view that maybe when we had that Biden budget buster back in March. Remember the March fiscal stimulus, which was enormous, followed the Trump in December of 2020. And maybe the Fed should have started getting the ball rolling at that point. It could be that they want to build up more bullets to fight the next recession. So there could be that part of it too, but it's sort of like, I'm going to raise rates so I could have more power to fight the next recession. It's sort of like, amputate my arm and then please sew it back on. I don't know that. I think that the Feds, I can't argue that their intentions aren't good. We're sort of caught between a rock and a hard place. This inflation is killing real wages, okay? It's killing real wages, especially in a part of the socioeconomic strata that, the lower end, okay? The poor, the middle income class, and of course the elderly too. They get killed by inflation. So that creates its own inflation, and the Feds, they're seeing we have negative real, so we're going to get inflation down. Because if we can get inflation down, you see, if they pull this off, get the soft landing, they will kill inflation, hopefully not kill demand, and by killing inflation, and if wages stay stable, all of a sudden, well, voila, that chart I had of negative real wage growth will hook up and we'll have positive real wage growth. They want to get inflation down to get the real wages up. But you see what happens when you raise interest rates is you end up throwing people out of work.
Right.
So I said before, I don't know, is it just coincidence that 14 rate hiking cycles, 11 recessions? So we've got to layer the interest rate shock. And higher interest rates work through the economy in a negative way, not just through higher borrowing costs, but also, as I said before, through the equity market and through the real estate market. And households in Canada and the United States have never been more exposed to long duration assets that are very interest sensitive. So there's that other aspect to it of what happens if we get into a period of asset deflation. Mm-hmm. And it's going to be very problematic. It's one of the reasons why I'm probably the only person in the world that are saying, we are now taking a new leg higher, 10-year Canadas, 10-year treasuries, long bonds. I'm saying, you know what, I'm at the point now where basically this is going to extract a lot of pain. Look, you're seeing it already. Look what the interest rates have done to the bank stocks. It's one thing, when market rates are backing up and the bank stocks are going up, this was last year's story, that's the benevolent story. But when the bank stocks are going down when rates are backing up, don't forget there's a certain cyclical element to the banks. The banks are involved in the real economy. It's telling us something that the rate backup, even though the central bank's doing anything, is already starting to hurt growth.
Mm-hmm. David, we're getting a lot of questions coming in, which we're going to get to in a moment, so thank you everybody for sending them in. I do want to ask you your thoughts on the impact of freezing Russia's assets in terms of when we talk about geopolitics and an integrated global economy, thinking about what this might lead to in terms of the alliance on energy dependence, Russia, China. You freeze your assets, maybe there's less demand for U.S. treasuries, U.S. dollars. That could be coming from Saudi Arabia. We, of course, heard that maybe they floated the idea of pricing oil in renminbi. Do you, as you look out, are you looking at the world where we might have two different world orders of sorts?
Well, I think that's a big part of it. The last part of the question would have been, well, which I get asked all the time, is the U.S. dollar going to lose its reserve currency status? The answer is not until there's something to replace it, and that hasn't happened yet, and may not even happen in our lifetime. I think that the freezing of the Russian assets, I would 100% support it. I think that we're probably going to see at some point very soon that Europe will actually issue that ban finally on Russian oil. This is the price we have to pay. This is the price that we have to pay. And so I would say that this is necessary to fight this war. Normally, when you fight a war, taxes go up. There is pain. Everybody shares the pain. And so that's part of that. In answer to the question, absolutely that, this was already starting. Okay, like the bottom line is that Putin's been planning this for a long period of time. You look in his office and there's pictures of Peter the Great everywhere. He's a tsar. That's really what he is. But even before this invasion, him and Xi Jinping formed this great partnership. They have this great partnership. So this is something totally different than, you go back to the early 70s with Kissinger and Nixon going to China to befriend China to isolate Russia, and now Russia and China will get together. I'm not going to say to isolate the U.S. You could argue that NATO now is more cohesive than it's ever been, that the U.S.-European alliance is stronger. That's an outcome from this, but okay, that's fine. But the Russia-China thing is real, and the U.S. is an economic enemy of China. China is an economic enemy of the United States. There already was an economic Cold War between China and the United States, and that's accelerating. And China's, commission by omission in this whole invasion of the Ukraine, speaks volumes of the Chinese-Russia relationship. Remember, China, for the past 7 or 8 years, was building the Silk Road all into Africa and South America. Why? To have access to raw material. Now they understand what's happening. They're going to buy cheap oil from Russia, and they're going to get all these tremendous rare earths from the Ukraine. I mean, China comes out of this, and I know it's a horrible thing to say, but China comes out of this, notwithstanding the problems they have. They're deleveraging, their property sector is imploding, but they're going to come out of this an economic winner. And it does absolutely mean that we're going to be in a bigger economic Cold War. And by the way, India is the same. India, here I thought this was going to be a great opportunity after Biden got elected for the U.S. to use India as an antidote against China. And of course that never happened, but even India stayed relatively silent. So yeah, I think that you're finding that the world has splintered. I think there's going to be repercussions. And it means, I'm not going to say it's the death of globalization, but certainly you could argue at least a partial reversal of that's going to happen.
Okay, thank you. I think we have some mic runners out there. I can see. So if anybody has a question, if they want to raise their hand, because I do have some questions. As you do, I'll ask one of the questions from the audience. And David, you brought this up in terms of the various central bankers' policies not being in the same vein as the United States in terms of raising rates now, which we haven't really experienced that much of over the past decade or so since the financial crisis. We had a lot of the global central bankers working in concert. Does the U.S. worry about raising rates too far ahead of Europe, which has paused? Do they care about seeing their currency rise too quickly because of the differential?
Well, I think that it's a great question. The bottom line is that the European Parliament has not been attacking the ECB, right? I don't see, when I'm watching Bloomberg TV, I'm not seeing a lot of people who would be of Larry Summers' intellect going on and criticizing the ECB. You don't see a lot of that. The bottom line is that I can tell you, I think what's happening here, a lot of it is political. Not a lot of it, some of it is political. Who's getting the blame for the inflation is Biden. It's very interesting, right? I don't know if you saw this. I think it was on Meet the Press on Sunday that Biden calls it the Putin tax, right? The gas, and only 6% of Americans believe it. They actually are blaming Biden. And they've been blaming Biden for the inflation for the better part of the past 8 or 9 months. And it's when these polls started to come out that you started to hear Powell turn more hawkish, not just him, but also Janet Yellen. And so he's getting blamed for the inflation. The polls are showing that the Democrats are going to get whipped pretty badly in the midterms. But you're not seeing that. You're not seeing any political pressure on the ECB. You're not seeing any political pressure on the BOJ. But there is political pressure. I've never seen, I've never seen a president give a nudge, wink, wink to the Fed to raise rates before. It's the first time we've ever seen this. Remember what Trump was doing to get Badger Powell to cut rates back in 2018? Well, it finally worked. So I think a lot of it is the political pressure, and a lot of it is, I think, that the Fed take them at their word, believes that their anti-inflation credibility is at stake. And even though inflation rates, you could argue, aren't as high in places like Japan or places like Europe, they're still extremely elevated. But I would tend to agree with you. And you think that actually, one of the things I should just mention is look what the US dollar's doing. It's breaking out sharply. If we can get into a situation, if, but that's the economist world, under the proviso of, that we can actually finally just stabilize. I mean, is oil going to go up another 100% from here? At some point, these things will stabilize, but the US dollar, there's lagged impacts here, is going to have a big impact negatively on inflation.
Okay. Questions, anyone? Oh, go ahead.
Hi, David. My name is Jeff Kerbison. My mother doesn't know what Bitcoin is, but she wonders if she should put some money into it. And I'm wondering if you think that cryptocurrencies will become a legitimate asset class for institutions or retail investors.
Well, I got a question back to you. Two questions. Does your mother have ice in her veins?
You're damn right she does.
Load up the truck. Does she like to sleep at night? So the answer is, it's a, what can I say about Bitcoin or Ether or these, let's call it the cryptocurrency space. It is very interesting commentary on human nature and human behavior. And I think that it's really a rich man and rich woman's speculative dream to Bitcoin. But why would you want to, firstly, how could it become even a store of value? It's so volatile. I can understand if you are a technical analyst and you could look at the charts and see overbought, oversold, and you can trade it. But how can anything be a real legitimate asset class when it can move up or down 20% in a week? Now, I'm not going to say, is gold necessarily an asset class? Well, gold has a history of thousands of years, and we know what gold is correlated with. Gold is correlated with, inversely, with interest rates, real interest rates. But gold is relatively stable. Gold does not go up or down 20%. There's nobody that ever, well, maybe except for Eric Sprott, nobody ever said buy gold to make a killing. Gold is a safe haven. Is there anybody here, when you look at the volatility in crypto, that would say it's a safe haven? How do you define a safe haven? How could something that's a safe haven be so volatile? Gold has much more stable characteristics. So to me, this is just, it's like the meme stocks. This is just basically Bitcoin, or the crypto space to me is just it's a torque on the most speculative elements of the S&P 500. Just go by the SPX and lever it up. I mean, it's the same trade. Now, in terms of it being an asset class, why would a currency be an asset class? It's cryptocurrency. I've been in this business for 35 years. Nobody's ever said to me, hey, Dave, do you think that I could formulate an asset class with sterling, the euro, Japanese yen, and the Swiss franc? Can I make an asset class out of that? I mean, what is it? It's a currency. Why would you make it into an asset class? How do you, when I think of securities, I mean, this is a CFA. So what is the dividend discount model? How are you estimating future cash flows from Bitcoin? How do you, at least you can value fixed income, you can value corporate credit, you can value equities. Give me the discount rate, future cash streams, take the present value. So what are we talking about here? About Bitcoin? It's just a speculative, quotes, currency. To me, it's the whole crypto space reflects a more efficient means of transactions and facilitating payments. I do not entertain it seriously as an investment. I would never recommend anybody buy it as an investment. If you want to trade it for fun, go ahead. That's what I would tell your mom.
Okay, thank you. Next question.
Now let me tell you how I really feel.
Go ahead.
Hi, Dave. It's Les Boris here. With the amount of leverage that Canadian and U.S. homeowners have exposed themselves to recently in this housing bubble over the last few years, at what level of interest rates do you think things are going to start crumbling in the housing markets?
Well, you know, it's a great question, and we actually wrote a report on this. And 100 to 125 basis points. And the bank's already done almost half that. The Fed is going to, maybe that the Fed wants to get there in a big hurry. I think that they'll probably go, this is why, look, you know, if you can trade Eurodollar futures past the June meeting, Fed futures contracts, or the front end, I would just say you don't want duration risk. I get it. There's so much uncertainty. There's so much rate hikes priced into the 2-year note. But I'd say that they go another 100 basis points more than what they've already done. You're going to start to see some nasty stuff happen in the second half of the year. So that's what I'm trying to say. Remember, the Fed couldn't get the funds rate. Here he is. Mr. Powell was saying in October of 2018, we not just have to get neutral, we have to get above neutral. Now, neutral back then, they said was 3%. They said neutral was 3%. He said we have to normalize interest rates, get it to 3%. They couldn't get it past 2.5%. Of course, how do you normalize interest rates in an abnormal economy? Remember how the repo market blew up in its face in 2019? And now the economy, tell me it's not even more abnormal than it was back then. And they're telling you we're going to go to 3% on top of quantitative tightening, which means we're actually going to 4%. Good luck with that. But to answer your question, 100 basis points additional from here. They do more than that, and it's going to be, I mean, the recession, I think, will be as close to baked in the cake as possible, if it's not already. But they can't go more than that. By the way, like I said, there is a trade there. And the trade there, without taking on duration risk, is in the front end of the Canada and the Treasury curves for the fixed income people out there.
Okay, buy short-dated treasuries.
Absolutely.
Okay. There's another follow-up question on housing. If housing and equities are owned by older investors who aren't leveraged, are interest rate hikes really a significant concern?
Well, you know, the answer is no. I mean, everybody's house price is going to go down. It's just a relative, I mean, it's like, you know, it's like you're at a party. My house price is up 20% from last year. Yeah, well, so is mine. Yeah, well, so is mine. Well, yeah, so is mine. Oh, go figure that. It's just basically so, you know, look, you're going to feel poorer, but everybody is going to be in the same boat. It's not like in the equity market when, you know, you say to somebody, I own this stock. Oh, geez, I wish I would have bought that stock. I bought this dog. You know, house prices will go up and down together. So, but, you know, I'm not like, am I going to sell my house, you know, because I'm bearish on, you know, but if I had a house as an investment, which, let's face it, what was that study from CMHC, which was astonishing, like the percentage of Canadian, well, this is in Toronto and Vancouver, so this is not about Winnipeg. This is called prairie pragmatism, which doesn't exist in Toronto, believe me. But the number of people that have multiple properties as investments, they're going to get hit. And those are the weak hands. Oh, yeah. People say, who's going to sell? And the same thing in the States, right? In the States, only 30% of the market has been first-time buyers. All these institutional buyers, they will be dumping those properties.
Okay. Any question from the audience? Hard to see with the lights. Yeah, oh, thank you, I see that.
Hi, David, it's Tom Ball. Over the past few years, in an effort to fight the pandemic, our governments have taken on huge amounts of debt, but at the same time, they effectively devalued our currencies, and the only reason we didn't notice is that everybody did the same thing. And so effectively, people estimated it was at least a 10% devaluation, maybe even larger. How does that fit into your inflation sort of environment picture and how the Fed is going to deal with that?
Well, Tom, that's a tough one to digest because, I mean, currencies by definition are a pair trade. It's a relative price unit. So I don't know if I accept the premise that everybody's devalued. To me, that's basically impossible, unless you were talking about devaluing relative to, say, the price of gold. Gold is hanging in well, but it's not as if it's been screaming higher to a new all-time high. You know, if gold was $3,000 or $4,000 an ounce, I'd be saying, okay, I see your point. So, you know, what can I say? I can say that currencies do matter for domestic inflation. I think that Japan is very problematic because they import pretty well all the raw material needs. I mean, except for rice. I mean, 90% of the country is mountains. There's an example. And the yen is breaking down. The yen is breaking down against the US dollar. So I don't know how anybody could say that the US dollar isn't appreciating against something that's so crucial. So no, I don't buy that. I think that Japan might have a certain form of stagflation. I'm actually, I've been a long time, not a long time, but I've been bullish on Japan for the past, you know, certainly since Abe had taken over and a lot of the structural reforms, but you got to be thinking about Japan. But no, the United States, I mean, the US dollar is going up against everything, and more recently against the renminbi. That's more recent development, but I think that when you look at the US, this is going to be, once we can shake out the commodity effects, the strong US dollar, the disinflationary impacts are going to be more evident, but there's lags, and this will be more evident in the second half of this year and in the next year. So I don't know, Tom, I don't buy into the premise. I certainly do buy into the premise that governments have dilapidated their balance sheets. That is 100% true. But then at the same time, that debt morass limits the ability of central banks to raise interest rates as much as they otherwise would have. So, you know, that's where I come out in terms of that particular scenario. But I would say this much, and I didn't mention it. You can't talk about everything, although I certainly did try. The Japanese yen, you know, I didn't mention this, but I mean, the Japanese yen is broken down. This is a fundamental price unit in the global financial market. It's broken down. And if you noticed today, the Hong Kong dollar is starting to trade down towards the lower end of its band. I'll just tell you this much. When the Japanese yen historically breaks down like this, it wreaks havoc in the Asian FX market and triggers global financial instability. Last time this happened, remember, was in 2015. That ultimately triggered that renminbi devaluation. That could be the financial event that we haven't talked about. Remember, the Fed under Janet Yellen had 3 rate hikes penciled in for 2016. And they only did one of those, and it was the very end of the year, after Trump got elected, and we had all the animal spirits. So that's the one thing I'll just say. So Tom, thanks for bringing up the foreign exchange market, because that's one thing I forgot to say, is that the Japanese yen is a canary in the coal mine for financial instability that we haven't talked about.
Why is it breaking down?
It's breaking down because the BOJ has capped their 10-year JGB. They're buying basically unlimited amounts of JGBs to target their 10-year at 0.2% at a time when the 10-year Treasury is, where do we close today?
Okay.
291 or something like that. So these interest rate differentials have gapped up dramatically. So it's really about relative monetary policy.
Given the fact that we have new charter holders this evening, this question might come from a millennial. It is a housing question once again, but I want to address it. What is your expectation for the residential real estate market in Canada over the next year? But more importantly, because we've talked a little bit about that, how would you advise millennials looking to buy a home in the near term?
Well, I am basically extremely bearish on Canadian residential real estate, except for 498 Brookdale Avenue in North York, Ontario. Look, I think that, so we did some work on where house prices in Canada should be if the home price to income ratio were to mean revert. Bob Fear's rule number 1. And the answer was down 15%. Okay. Then we layered on, well, what happens if you have to mean revert that under the Bank of Canada's interest rate scenario? And it's more like down 25 to 30%. That's how bad this could get. Because we're starting out, the starting point is extreme overvaluation on the price to income ratio. I showed you what it was in the States, 8 years of income to buy a home. What's normal is 5 years. In Canada, that number's at 12 years. It's crazy. And so I would say that, for the millennial hipsters out there, continue to rent and then pick up the pieces 12 months from now when prices are down a lot. You're going to get a great buying opportunity.
Okay, great.
But 498 Brookdale's not for sale.
Now we know where you live. Any other questions from the audience? Difficult to see.
Nobody asked why the bar's not open, which is very disappointing.
Okay, 1 second. There's just one back there, and then we'll come to you.
Hi, thank you. Just curious what your take is on the dynamics you're talking about of the real estate market, et cetera, and fixed income market with low interest rates. It seems to me that's also working into the appetite at the institutional level and also the retail level for alternative assets, which are supposedly less volatile, more stable, et cetera. I'm curious to hear your thought on valuations in that sector and the outlook. Thank you.
Well, I think that that is exactly where you might want to be focused. Your attention is going to be on private equity, not just private equity, but private debt, notwithstanding the valuations. And I would say that there are secular themes, coming out of these recurring crises. One of them that is, I'd say, probably most important is global security of food supply. And so I would say that farmland in stable parts of the world, this is where Canada can shine, by the way, I think is a bona fide. Of course, you got to sacrifice liquidity. But we come out of this with farmland being extremely important. I'd say that what doesn't get a lot of attention also is fresh water. And there is a freshwater scarcity in the United States. This again, and by the way, there's different ways that you can play this in the alternative space. We can talk about one thing that I talked about was about the partial reversal of globalization. But what's going to happen is there's not going to be onshoring, there's going to be nearshoring. And I can tell you one particular country that's going to benefit, especially from what's happening in China and this economic Cold War, and the need for American companies to outsource but to lower cost regions, because the US is not a low cost region, is Mexico. So Mexican assets, and by the way, they are in the process of being revalued upwards. And then of course, you've got different ways that you have to play a really big shift in European, diversifying Europe's energy needs. And this is, I think, where LNG in North America is going to be in a secular bull market. So those are the ideas I have in terms of alternatives that have nothing to do I think, nothing to do with my call in the recession. And that's what you want to be thinking, is how do I invest? I would say that I would rather be investing, in answer to the question, on private debt and private equity with those particular managers that have a long-term horizon than in the public markets, which I think will get hurt relatively more from an economic contraction phase. Thanks for the question.
Okay, one last audience question here. Thank you.
Good evening. Thanks for being here. Question is, you made some comments earlier on about soft landings and the disruptions that happened that caused it. So Saudi pumping oil, the internet. So right now, in a scenario, hiking of interest rates, what are some scenarios you can think of that might be the next disruption that might help land a little more softly than you're envisioning right now?
That's a real tough one. I mean, we could talk about technology, talk about 5G. Then again, China's so much further ahead than anybody else in that regard. But that's not going to help. I mean, the internet was like inventing electricity. I mean, it was just something that was, when you go back to that period, we would have definitely, I think that, you remember in that period, the Fed flattened the yield curve in 94 and in 95, took out Orange County, we had the Mexican crisis, a couple of mortgage funds went under, and it looked like we were going to have a recession. And then, of course, we had the internet is like a once in a century, maybe more than that. It was like a new industrial revolution. So I don't know. The Saudis, what do they have? 2 million barrels a day of spare capacity? They can't do what they did back in the mid-1980s. Let's say all of a sudden there's a kumbaya moment and we get peace. We get peace, Russia, Ukraine. I mean, that would help. But it doesn't stop the fact that Russia, so there'll be peace. Putin will say after he flattens Ukraine, there'll be peace. And so what does it even mean, basically? So I'd like to think that would be a resolution. And it's very complicated in a lot of respects when we have to think about Catherine's question before about Russia is not going to be part, and people, when I hear people say, well, it's an insignificant country, they don't know what they're talking about. It's a massive supplier of commodities, and the Ukraine even more important, especially for food, especially for neon gas, which goes into semiconductors, that compounds that problem. I don't know if people understood how important Ukraine was from a commodity standpoint. So I don't know. I mean, it's tough for me to think about this time. What is the rabbit that will be pulled out of the hat that could prevent a recession? I mean, I think about these things. I just don't. Nothing is really, jumps out at me. I'm willing to entertain, any notion. I think that the one thing that I would say, and it's not that sophisticated, is that if Catherine is right, that maybe the Fed's just barking. They want the markets to do the job for it. The market's done the job for it. They're going to start to ease off. If we get the inflation stabilizing, and that's good enough for the Fed, or it comes down a little, that's good enough for the Fed. The one thing that I'll say is go back to what I said before. If the Fed could see that inflation a year from now is going to be not at 2%, but maybe at 4%, and that's good enough without tipping the economy in recession, I'd be happy to change my call. A lot of my call is just saying, well, this is what they're telling us they're going to do. If they do it, this is what's going to happen, and maybe they don't do it. So I guess in answer to your question is if the Fed is barking and not biting, then there's a chance that we can skirt through with a soft landing. But I have to tell you folks, I cannot believe how strident they've become. I can't, my head's spinning at the 180 that they've done. They've done, I don't think I've seen anything this radical before. And now, we'll see what happens. But I guess that would be the out, barring some other massive exogenous shock. that would be positive for the global economy. I can't think of what it is. But if the Fed maybe goes one or two more times and that's it, I think there's a chance that we can get that soft landing.
David, was your head spinning when we saw on the front page of the Wall Street Journal today Janet Yellen's comment that it will take, in order to do what the Fed's planning to do, skill and luck?
Skill and luck. Yeah, well, that sounds about right. You know, we can all use a little bit of luck. You know, I said this is a humbling experience, right? Forecasting is a humbling experience. So, yeah, you know, skill and luck. I think the Fed, you know, as I said before, I think that the Fed will not have to do a lot as much as they think to get inflation down. Right now, they're signaling otherwise. But I was just saying before, look, everybody in this room who is a money manager, and look, I'm not a money manager. I don't have that skill set. I don't have that temperament. But we're always basically playing the odds. We're playing the law of averages. So, like, I just could have come in here tonight with one slide, and you wouldn't have to hear me pontificate about all this other stuff. Just a slide, 14 Fed rate hiking cycles, 11 recessions. It ain't no happenstance. Okay, this is what happens with interest rates and liquidity. The markets breathe liquidity. It's the oxygen tent for them. The economy, interest rates, that's why we have cycles. You know, you talk about recession to people, it's like you're a doctor giving a horrible medical diagnosis. Folks, it's part of the cycle. Recessions, expansions, expansions, recessions. Expansions, thankfully, are long, typically strong. Recessions are short, although they can have a big impact on your financial performance and your job. That's why they say, you know, in a bull market is an escalator going up and a bear market is an elevator going down. But I'll just say, so look, it's where we are in the cycle. I showed you we're 82% of the way in the cycle. The Fed's raising rates. Maybe they're late. Maybe they feel they got more to do. And but we just know the historical record. Do the math. 14 rate hiking cycles, 11 recessions. So the question is your portfolio and asset mix reflecting not 100%, there's no 100%, but is it reflecting an 80% chance of a recession? Because that's what those odds are right now. And don't think you'll be able to time it. Just know that it's out there, probably between now and the end of the year.
That's great insight and advice, David. And just to wrap it up, one last question, which I think we can end on, is the future seems pretty glum. Is there anything positive to look forward to?
You know, it's a good question. I think that, I mean, I'm a Montreal Canadiens fan, so I got nothing. I got very little to look forward to. At least you folks won the Grey Cup, so I mean, you've got to be happy about that. Am I right? I'm right about that, aren't you? You beat the Tiger Cats. Back to back. Okay, that's like, remember the optimist pessimist. Doesn't get any better than that. Yeah, look, I think that, you know, that's actually, I'm going to tell you, Catherine, very, very, very unfair question to ask a perma bear.
That's why I asked you. It's a perfect opportunity.
I think that, look, I will just say this much. If you're maintaining, look, I'm just going to come back and just say that so long as your mother is not buying Bitcoin, you'll be all right.
Okay. David, thank you very, very much for being with us tonight and having a very in-depth, great conversation. I think everybody can appreciate David's history and knowledge. So thank you again for being here. Thank you, everyone, for being with us tonight. And I would like now to invite Brendan Hargrave up to the stage. He is a Vice President, CFA Society Winnipeg, and Chair of tonight's dinner to say a few words. Thank you very much for being with us and allowing me here tonight. It's been fabulous and so nice to see everybody in person.